Okay, welcome everyone. We'll start our lesson today. Today lesson we'll go through LO1, Learning Outcomes 1, Record Business Transaction using double entry bookkeeping. And we can prepare the trial balance from the double entry bookkeeping. So if you're a bookkeeper, you have to prepare accounts according up to trial balance. From the trial balance, we prepare our financial statement. Yes. So maybe a couple of you heard about, those are listening this recording. Financial statements. So four types of financial statement we prepare account. Do we know which those statements? Have we heard about financial statements before? Statement of profit and loss. Statement of financial position. And statement of cash flow. And statement of change in equity. Equity means shares. So these are the four statements. So today lesson we are looking more double entry and the trial balance. Yes. Okay. Any question? We okay here up to here? So just need to keep in mind, please. We need to prepare four types of statements. And if you're a bookkeeper, you have to prepare up to the trial balance. Okay. So this is, so what we do, we always record transaction rule of debit and credit. So what is the rule? Debit and credit. So if we'll say £100 debit, let's say we purchase furniture. Furniture is our okay, so £100 is debit our furniture. We are going to purchase our furniture. So furniture will be debit £100. And if we are paying by cash, so cash will be credit. It means my cash balance is going down. To understand, and then we prepare in the trial balance, my furniture balance will go on the debit side and the cash balance goes on the credit side, which went down. So these transactions we record in the trial balance, which we can look around today's few trial balance, and I'll give you handouts, to go through the double entry bookkeeping. Okay. So first thing, double entry bookkeeping, like here we quoted example. If we not paid the cash, then will be payable. It means in future dates we will pay. That will be our account payable. Okay, so two types of accounts we have. One is called management accounts, which is internal. So as a manager, we prepare management account, but we are doing financial accounting, which is external. We have to prepare the annual reports. We have to submit to HMRC, and we have to be published if we are a public limited company in the company house as well, which is a compulsory for. So the difference between management accounting is internal, financial accounting is external reporting, management accounts we prepare for planning, financial accounts we prepare for external, people can measure. Financial accounts is a legal requirement, but management accounts is not a legal requirement. We prepare or we don't prepare. So four types of the statement is a compulsory. So we have to prepare those statements, and those are the crucial to prepare. Nature of information more financial, and the management accounting is more financial and non-financial. Time period. So the time period is a historical figures, but financial accounting we have to prepare every year. Okay. So then this is when we record the transaction, it become a financial data. The data we can use various raw facts and figures we are putting into financial statement by the rule of double entry bookkeeping, and that data will help to make the decision. Financial data, then it become information. If you have information, it become a knowledge. So that's why always we need to be keep up to date information so we can make the right decision in the business. So that is the crucial for any business to be have a information. So information we record in accounts as a transaction. Okay. So when accounting consists of recording the transactions, you record them with the rule of double entry, and then you summarize it, and then you in the trial balance you summarize it, and then you prepare the statement with the legal requirements. So we management accounts for internal use to see how much money in the business and how much money out from the business. That we do in the management account. And the financial accounts we prepare to meet the legal requirement. So this is all about the discussion is okay. Nowadays we have accounting standards. So what is accounting first? Let's we'll discuss about accounting. So we have our title of the unit is called financial accounting. Financial accounting. So what is a financial? Financial is mean anything related to money, anything related to finance, we have to record it. So accounting is is the keeping of the financial record up to date and the preparation of the financial record and the statement about the organization and organization. It includes the recording the business transaction in a money term, recording the financial information for managers, and advising owners to be financial reports, which is we mentioned 4 types of financial report: statement of profit and loss, also known as the income statement; balance sheet, which is also known as statement of financial position, which shows asset liability, which I'll go through in further lessons as well. We will prepare these statements. Okay. So where accounting start? Accounting start with the transaction. Okay. Transaction. Can you hear me? Okay. Accounting start with the transactions. So when transaction So when we deal with the transaction, so purpose of accounting system to ensure the transaction is recorded correctly, gathered information, and then on the basis of this we make. So first transaction, then we have a primary document. When we have a sale invoices, purchase order, these are the primary books, prime entries and the ledgers, which we will go through and we'll discuss in detail. So accounting, why company keep record? Why we need to be these record the transaction in art? So for internal control, to provide procedures to all transactions, customer query can be addressed, use generate accounts, and meet the legal requirements. So that's why we prepare accounts. But there is no purpose to be do, and because that's we have to. So primary document and the book of prime entry, what is about? Transactions. Cash sales is the transaction. So when we sell something, we giving the goods away and we getting the cash. If we're not getting the cash, okay, that's we need to make sure we record all the transactions. So transaction, then we have a primary document, which is mean invoices, then the book of prime entry. So we have a separate book where we can say cash sales, cash receipt, cash in and out from the business, sale day book, where we can record the sales, where we can record the purchase. So these books are known as the book of prime entry, primary document, and transaction. Any question? Okay, please, if any question you can ask. Okay, so next we looking, these are primary documents. we prepare in accounts. And the principle of double entry bookkeeping is a dual effect. You have debit, you have credit. You have debit, you have a credit. Double entry. Yes? It can't be debit, debit. So it's a dual effect. One thing will go. So this is accounting equation. Assets always when increase we do debit. Liability. So if we have a debit side, so we need to be remember the word debt click. To understand the double entry bookkeeping, we have to remember the word debt click. What is a debt click? So what is goes on the debit side? Is expense goes on the debit side, asset goes on the debit side, buying goes on the debit side. What goes on the credit side is liabilities goes on the credit side, income goes on the credit side, and the capital goes on the credit side. So debt click. In my next slide, this one, debit and credit. So you have to remember when these increase we do debit. When decrease, we do opposite debit is a credit. So credit side, when liability increase, we do credit. When income increase, we do credit. Liability mean we have to pay something, we borrow money from. So asset, anything you own it, like furniture, property is your asset, education, even you have skills is your asset. That's why people use the term asset. Education is an asset which never lost. So liability, anything you bought on credit is a liability. You have to pay in the future dates is your liability. So liability is when increase we do credit. When liability decrease, when we paid off, that's we reduce the liability, we do debit. When income, when we sell more goods, we do credit our sales. And when somebody faulty goods return to us, we do debit. Expense. So to understand this, the betterly, so I'm going to show you double entry bookkeeping handouts which we'll use. And these will be available. So that's we need these handouts. We need to do practice. Please, no need to be, because it's the first lesson. Maybe you never learn about the double entry bookkeeping rules. So we need to really go through the concept. This is a basic concept. Hello, can you hear me? So I'm just going to open this. The world should be open now. Okay, so every debit has a credit. So we'll do some double entry bookkeeping. Let's please. So we are going to read this first. We are going to ATHE Limited is going to start a business. Which date they are going to start a business on the 1st May. So 1st May we have invested £50,000 in business. So 50,000 we have invested money from personal account to our business account. So 50,000 will be debit in the bank, money coming in the bank, and credit will be 50,000 in capital. So capital is mean the investment in the business. It will say you have a shares in the business. It means you have a capital in the business. You have an investment. On the following date, we bought motor vehicle. So if you keep in mind the slide, debt click. What is debt? D-E-A-D, debt click. Keep in mind. So first was the capital. We invested. Capital is a debit. Money came, that was asset, cash, so that is debit, and the capital was credit because both are increased. Then later dates we bought a van from the cash which we have. The cash we paid because our cash was in the bank, so bank balance is going down, which is in our locker. The cash bank doesn't matter is the cash in the bank or cash in your locker, which is decreasing. And my van is increasing because we bought £10,000. So van is coming in, that's the debit, and the cash is going out, that's we do credit. Okay. Then the later date we bought the goods from the Rambo suppliers. So 17,500. So we bought purchases 17,500. but we purchased these goods on credit. We not paid any money. So Rambo's supplier is our creditors to whom we have to pay the money in future. Creditors mean our suppliers, those suppliers goods without the cash. So those are our suppliers. So those we have to do. Then bought office machinery. So office machinery will be debit by 8,000 and the bank will be credit by 8,000. Then the later date we sell the cash sales. So cash is coming in. We sold the goods. So sales is a credit by and the cash is a debit by. So that's we need to do debit and credit. So please, this handout, you have two copies. One is a student handout and one is a tutor handout. So tutor handout is the answer. So please go through these based on the rule that click. So handout that click double entry bookkeeping. So double entry bookkeeping is also, we need keep in mind the accounting equation which will use asset equal to liabilities plus capital. So as I mentioned, we prepare the financial statement, statement of financial position, statement of profit and loss. And these statements, you know, of course, we have a lot of accounting software nowadays. We do entries in, but we do the rules in double entry bookkeeping. And that's, you know, we prepare. We have accounting standards that give the rules, you know, different rules to be record the business transaction. In the UK, standard is called Statement of Accounting Practices. In international standard, which is set by the International Accounting Standard Board, and that's throughout the world, you know, if we follow the same, how, like, you know, I can say revenue. Revenue means the value of the sale. I can say revenue. I can say turnover, and I can say sale. It's the same thing. So when I'm using international accounting standard throughout the world, I'll use the word revenue. So these are the standards. IS2 is about inventory stock, and IS16 is, these are the standards which we'll discuss in the following lesson. So when we look at record the transaction, we record the transaction when my accounting period starts and when my accounting period. So if you start your business 1st January, finish 31st, so this is your one accounting period. But the tax year is start 1st April and the 31st March. So what we need to do, we need to divide our tax rate according to 2 years. That's we need to be make sure. And what we do, we have rules in. We want to be prudent always. We want to make sure our income and expenses will match against it. We have a consistent policies in accounts and we will follow. So the business, all these statements should be relevant. Compare each year. We not only prepare, give the information 1 year to, if we are new business, we can give 1 year. Otherwise, we need to give the report so we can see, people can see last year our sales, this year our sales, how much went up and went down. That's, you know, different user of financial statement, like, you know, the investors, and they can look around the information and record. So if you are a bookkeeper, because you work up to the trial balance, and double entry bookkeeper normally is record these transactions, recording, classifying. In asset is the liability section. So we can report it in the shape of the financial report, and then different people can look around the last year, how much my sales went up, went down, by looking the business transactions. Okay, so today we'll look around the book of prime entries, sale day book, documents, recorded sale invoices. We can summarize it, which we can. So purchase day book, we do debit because the goods coming in, and the VAT 20 we do debit, and if we not paid it, we credit the trade payable. We have to pay in the future state. So that's debit, £120 on the debit side, £120 will be on the credit side. So that's my double entry bookkeeping. So please, we need to look around the handout double entry bookkeeping, which we'll go through the following lesson. So like if I'm recording, because nowadays we have a books, you know, so I can say I invoice number so and so, the customer was this, we under this code which is we use in the software, and how much worth of the goods, how much VAT, 20% VAT on it, 60%, whatever the VAT rate, so we can calculate. So net figures was 4,000 worth of the goods, 800 pound worth of the VAT, which is 20% off for. So we can record in the book. So that's my debit side. This is, and something if I not paid it, so will be credit side as well, which is purchase, that is account sale ledger control account, which we'll go through. So in the same way, in a purchase day book, we purchase return. If the goods return, we do opposite transactions, debit, and we have a cash book where we can say how much money in from the business or out from the business. All we record, these transactions. What is the VAT? The value added tax we record in. VAT can be including VAT, excluding VAT. That's, we always copy these, and the basis of this, we can prepare our accounts. Okay, so when we look the profit and loss account, so it shows our sales, it goes cost of sales, expenses, and when this is profit and loss pro forma, how we can record these, from the trial balance, which will go through the trial balance, and then we prepare the balance sheet from it. Okay, so that's, and then this will be look like, so then these are the links, to look around the Tesco and Morrison financial statement. So please, today lesson, we need to go through this handout. So homework. So what we need to do as a homework, we need to look, putting your homework. So we need to look around the double entry bookkeeping, this lesson. So double entry bookkeeping. Handout, student handout, and answers tutor handout. That will be available on Moodle. So we need to go through, please. Okay, look around this. We all been filled double entry bookkeeping. Look the question and the next lesson, and put the rules, please, in your head. Debt click. What you just need to be make sure remember the word debt click. What is a debit and what's the credit? When accounting start with the transaction, what are the book of prime entries? I'm not going through today bank reconciliation, which will go through the following lesson. So today you just need to remember the debt click, debit expenses, debit asset, debit drawing. And what we need to be credit, the credit side, we need to go through liabilities, income, and capital, and that's all today. So that's you need to be debt and click, debt and click. When increase, when decrease, that will be opposite. So when your expenses decrease, you do credit. When increase, you do debit. So that's if you have more electricity bills coming, so you do debit. But if you not paid it, you create the liability because that bill is outstanding, you not paid it. So that's the double entry bookkeeping. So guys, we need to make sure we'll go through the next lesson. Up to next lesson, it will go through double entry bookkeeping. Look around the handout, which will be available on Moodle, and I hope we'll speak to you during our next lesson where we look around. If we need to be arrange extra sessions, we can. And today lesson was LO1, learning outcome 1, which is double entry bookkeeping based on the debt click, and we have a handout that we need to go through. Thanks for listening and attending. Any question, anyone? Any question? Wanda, can you hear me? Is it any question? If you have, please. If you want to ask. So yes or no, please. Can you hear me? Okay, guys. Today we'll keep up to here. If you have any question, you can drop me email on my email address anjum@ukversity.co.uk, and the next lesson will go through our LO2. So LO1 was just the double entry bookkeeping rules we have to follow based on the debt click. Thanks for listening and attending, and I hope so I'll speak to you all at next lesson. Thank you. Bye bye.